welcome to our November podcast, Dan. Great to see you. And as always, the goal of our podcast is to talk through some of the most frequently asked questions that we are getting from clients, because we feel that if the clients are asking about it, then other investors are interested as well. And as for us, we also use this as a real-time pulse as to really what's on the mind of investors everywhere. So that's what we try to accomplish. And lately, Dan, one theme keeps showing up, right? We're just talking about it, whether it's in conversations, whether it's in market reactions, whether it's in earnings calls, or even on a CNBC panel. The term is AI, right? So we're going to talk about that again. I heard Steve Wapner, he does, I know, the lunchtime show on CNBC yesterday.
The judge, right?
The Judge Wapner, that's right. And he said it yesterday. He said, I'm getting tired of it. He said it's all AI all the time on their network. But it's true. That's the biggest theme and question we're getting from clients last month. So we're going to talk about it again, just maybe in a little bit of a different way. So, and it's all over. It's in the market, the economy, corporate strategies. It's all orbiting around AI. So here's a quick roadmap for today. So we're going to, again, talk about what's happening in AI this previous month and probably why it matters and why you should care, right? And then we're going to do a look back at 2025 market performance with an eye towards the last couple months of the year. And then hopefully, if we have time, I want to talk about the fastest growing investment structure in the industry right now. And a lot of our clients are investing in it. They might not realize it, but it's active ETFs. Okay, I want to talk about why they're really disrupting the mutual fund market. So we can look at that. So let's start the AI conversation a bit, Dan. And when you look at it, if you think about the spark that kind of lit the fuse of AI, and I remember you mentioning this, by the way, back in 2022 when it came out. And it really, you can go back to the release of ChatGPT. I remember you on the webinar. I remember you had mentioned it, when it came out, it'll be the 3-year anniversary, November 30th. And I remember you saying there was, it took about 5 days to get to 1 million users, right? And that was a record. And then it was 100 million users in 2 months, which was the fastest adoption of any consumer technology in the industry. And now here we are in 2025. And I think the stats are now, it's definitely one of the top 5 visited websites. Yeah. And it's like 800 million active users, right? So Dan is our technology person. In full disclosure, I still have a Commodore 64 at home. So Dan's better at this. So what do you think? What's the latest?
I mean, listen, the AI marketplace continues to be just amazing. I think we talked about it a little bit on last month's call, but just in terms of the representation of the Mag 7 and really, the Mag 5, so to speak, pushing 34% plus of the S&P 500 right now in terms of market capitalization. It is just, it drives every conversation right now. And what's crazy about it is that in terms of adoption, like functionally how companies are using it, roughly only 37% of large U.S. companies are currently using AI as part of their core, regular production, right? And that number is expected to rise, next year this time, expecting a 50% utilization rate. And then in 3 years' time, north of 74% of companies expected to utilize AI as part of their core functions. So, it feels like at this point we're so late into this cycle, and AI is such now a household phrase that gets thrown around. I mean, even my, aunts and uncles and that are never been interested in this area of the marketplace, it's coming up, which gives me a little bit of pause. But at the same time, you're starting to see, real productivity gains in everyone, in everyday life. I mean, even in our own lives, right, seeing certain aspects and utilizations of AI make, taking client notes more efficient and doing research and things like that. So it is, it's really incredible.
Yeah, we should talk about that. It wasn't, we don't have a script because we never get a chance. Yeah. We're so busy to talk about what we're going to talk about. But, we have a great technology piece, Zox. You want to explain what we're doing with Zox?
Yeah.
Not that we're able to promote the
No, but it's just
technology.
An example of efficiency, right? So in our line of work, as you all know, we have a lot of client conversations. a lot of key details that get discussed, a lot of action items and follow-up. And, the old-fashioned way of doing it was a pen and paper, putting it in your client relationship management tool, and then, relying on that in conjunction with your memory to really meet these client needs and follow up. And now having AI assistants and AI agents and things that, are prevalent in our business, when we have a client conversation, we have a phone call, we have an in-person meeting, we still have our own notes, and old habits die hard, but having that AI assistant that captures all the things that, maybe we heard, but we didn't jot down, or something we said we were going to do. It provides a playback, it provides notes, provides action items, and it really just makes us more efficient. So you think about that on a small level, and then you apply that same level of technological, assistance across the core business function for manufacturers, telecom companies, banking and finance, healthcare, and imagine all the efficiencies that'll continue to get unlocked over time. It is really incredible.
Yeah, and there really is an arms race when you look at what we call the hyperscalers. And I'm looking at some stats here. The 4 largest AI infrastructure firms, which are Microsoft, Amazon, Google, and Meta, they're now committing this year, and we'll show a chart on this, to an astonishing, I think, $450 billion in AI spending just this year alone. Just think about that number. And I remember you had mentioned back in our February webinar when we thought the beginning of the year was just over 300 billion. So now we're at 450 billion. By the way, that 450, we looked up some GDPs of countries, pretty large countries like Denmark, close to Norway. That's like the GDP of the full country. And these are what 4 companies in the US are spending. And which it's even more amazing that the spending is coming from their existing profits. They're not, these companies are so profitable, they can put that money into it.
Now, one of the things that we have seen, right, and that figure, by the way, is expected to grow to over 7 trillion of AI CapEx by 2030.
Wow.
So at that point, right, that's larger than the combined GDPs of Germany and Japan combined.
Right.
So that it's truly a stunning level of expenditures. But one of the things you saw, and this was part of the Meta sell-off that came out, after earnings release last week, great earnings. However, you notice that for the first time, they started to finance some of their CapEx with debt.
Right, they did say that, yeah.
And the conversation today was similar with Google and OpenAI, another debt issuance, or the discussion of a debt issuance. And that, while it makes total sense given where interest rates are and how well these stocks are doing, why would you do it with equity and cash flow when you could do it with cheaper debt? Right?
Especially since these companies, they're so profitable that their interest rate on the debt is something like,
it's like 5 to 6% or so.
Right.
Now, what's interesting, though, is this was kind of the first time where you look at this CapEx and say, okay, it's not purely a net positive now, because if it's pulling into the banking system, we're doing lending. Now we have potentially some systematic risk that's being introduced, depending on how large this issuance gets. And that issuance specifically has already gone up from about 10% of the market to about 24% of the market.
Right.
So that's something we have to watch.
That's new.
Definitely new.
So let's go to our first chart. And you can see on the first chart, it's exactly what you said. Basically, it's just going off the chart, so to speak. If you look back, this is total CapEx expenditures from what we call these AI hyperscalers. And we include here a couple more. We have Alphabet, Amazon, Facebook, Microsoft, and Oracle. Yep. But yeah, about 10 years ago, in 2015, you're looking at, it's hard to see on the chart there, roughly maybe a $15 billion spend. So now you're off the charts. Like you said, the projection's going completely off the charts there. So let's talk about where the money's going. Now, everybody knows a lot of it's going into NVIDIA to buy chips. A lot of it is going directly to AI, we'll call it like software platforms like OpenAI, right? By the way, OpenAI went from about 0 in revenue a couple years ago, right? And I think they're going to do like 13 billion in revenue. So they are growing.
And they're projected to do north of 100 billion in revenue over the next handful of years.
So they're going to go up that much. Yeah. But then there's data centers. I saw a chart this morning, the expense in data centers, they said right now, data centers are on pace to rival all commercial office construction combined this year. So one area.
It is crazy. Now, if you look at this historically, right? So I know one of the The double-edged sword of AI is that it's exciting and the promise of what it could be in the future is really boundless. But at the same time, you know, we've all lived through enough market cycles now to kind of always in the back of your
Right.
mind is, when's this party going to end? And one of the things I was looking at today, which I thought was super interesting, was the amount of investment spend as a percent of US GDP. And looking back at some of the prior kind of corrections and major market disruptions. So current AI spending right now is about 5% of US GDP. Okay. If you go back to the tech wreck,
Interesting.
it was 5.2%
Okay.
is what, software, fiber build out, all that capped at. If you go back to leading up to the great financial crisis and you think about the expansion in real estate investment, 2005 housing boom was roughly 6.7% of
Right.
US GDP. So we're still below those two priors, but you can see that, from something that 3 years ago was basically at zero to now making up 5% of spend of the
Right.
US GDP is an astronomical amount of growth.
Yeah, it's interesting to bring up some of the negatives or the other side of it. And I just heard a term for the first time this morning on CNBC, and they called it AI washing. And what that is, obviously you're hearing a lot of layoffs. That you hear the concept that AI is replacing workers.
Yeah.
And I think there's a perception out there, this AI washing, is that maybe corporations are blaming it a bit on the technology when they really just want to cut costs, and it's really just good old cost cutting. So that's an interesting thing to keep an eye out for. But but there'll definitely be some winners, and there's a lot of them. But there'll definitely be some losers, right? And we still are early, but it's still hard to tell whether we're going to. I know there was on CNBC an article they wrote today. They interviewed a professor from University of Pennsylvania, and he's saying it's still difficult to replace people with AI.
Yeah.
It still takes people to run the data and interpret the data.
Absolutely. So, right now you look at productivity increases versus cost cuts, right?
Right.
And so far, roughly 11% of headcount reductions are directly tied to AI, right? So it feels like much more than that.
Right, it does, yeah.
But it's still, and again, that number, we expect another 4% in headcount reduction in a year's time, and then, more than 11% over the next 3 years. But that might not be coming direct layoffs. That might be increased productivity, so hiring freezes, less customer support or operational back-end IT.
Mm-hmm.
So it'll be really interesting to see how this shakes out. But, you can't avoid the headlines that, the great AI layoffs have begun, and it's really starting to impact tech.
Yeah, and maybe next month we won't talk about AI. But again, if it's still a waiting of
Yep.
questions we're getting for clients, I suspect that we might bring it up as one of the third topics. So let's shift gears a little bit and
Sure.
talk about a little bit of the we'll call it like a stock market check-in. Another good month for stocks, the Dow and the S&P for the month of October. Just to timestamp our call, we're recording this right now on Election Day.
Yep.
So we are November 4th. We had a little bit of a down day today, but the Dow and the S&P were up about 2% last month. And by the way, it's the 6th monthly gain in a row. We look back historically, that has only happened 6 times for the S&P to be up 6 months in a row. The NASDAQ made it 7 in a row, and the NASDAQ led the way up about 4.7%. And so if you look at our next chart, you'll see, if you look at it's a kind of a bullish outline. This comes courtesy of Fundstrat, Tom Lee's firm. And if you look back at the other 6 occurrences, 1935, 1936, 1942, 1958, 1980, and 2017, when the market was up 6 months in a row, the following month we were 5 out of 6 positive. Okay, and on average, the return was positive 2.4% in November, and then about 2.5% in December. So if you look historically at the markets, when it starts rallying at the beginning part of the year, it usually does end strongly.
Yeah. I think the only counter I would see in the short term, and you may feel differently about this, is that I do get the sense, not to beat on the AI horse a little bit, but people are looking for an opportunity right now to find some weakness in the market.
Right.
And there is some underlying weakness.
That's what happened today a bit.
Yeah. And so, I think one of the things that, as a client, putting myself in the shoes of an investor, right, and sitting there and saying, hey, you're potentially in for a little bit of a bumpy ride over the next couple of weeks. That doesn't mean that it's not going to be a good, trip through the end of the year.
Right.
But I wouldn't be surprised if you see some of these tech names sell off in a big way.
Yeah, a lot of technicians, if you look at just charting of the stock market, a lot of technicians are calling for a rocky start to November. So we could have some choppiness. We had a down day, as we mentioned a couple times today. Could have a little bit of a sell-off, but a lot of them expect buying. Seasonably, November is the best month of the year. On average, if you look back to 1950, on average, the S&P is up 1.8% in November. So people look at those seasonal factors. Also, on the other side this year, there could be some performance chasing when you get hedge funds that might be behind the market going into the end of the year. I think these dips will probably be bought, but we're due for a bit of a pullback. I think it will get bought.
Yeah, I would tend to agree with that too. And retail investors have been strong in terms of buying these dips throughout the course of the year. I mean, even more so than the institutional money. I will be interested to see how the renewed hawkish tone of the Federal Reserve plays into potential angst going into the end of the year. I don't know if you have some thoughts around that.
That's it's going to be interesting. We had 2 dissents again from the recent rate cut that we had in October, and I think December is really on the table, but it's becoming iffy. So we'll see. There's going to be fights back and forth there. The other thing to bring up, we can talk more about the Fed, but is that the market rally has been, especially last month, was very narrow. I remember just anecdotal and just looking at one day, I think it was last Wednesday, I was talking to a client. He looks at his account every day at the end of the day. A lot of our clients do. And he kind of noticed that the indexes were all higher, and then he was down for the day, which was unusual. So when I looked into it, the market breadth was amazing that day. It was almost a record for an upturn. There was at one particular day, there was only 104 of the 500 S&P 500 companies who were up for the day, with the Dow, NASDAQ, and the S&P 500 all nicely higher. And 496 stocks in the S&P were either flat or unchanged. So that's a one-day sign of very negative market breadth. Another stat I saw this morning, surprisingly, the markets are still near all-time highs, but 22% of the S&P 500 company components are 20% or more off their high. So some of the 6% of the S&P is currently at a 52-week low. That's no doubt higher with today's market being down a bit. And even 2% of the S&P 500 component companies are below their 50-day moving average. All kind of signs of weakness. Remember, the S&P 500 is market cap weighted. So the big companies like NVIDIA, Microsoft, Google, they can, if they're up, the index is up, but it doesn't mean your portfolio is necessarily up if you have a broad basket of stocks.
It's really tough and challenging for clients in this environment too, because if you believe in diversification, right, and you want to spread your bets a bit, so you have mid cap, small cap exposure, some international, even if you just own the S&P in its entirety, right, there's going to be days where inexplicably the portfolio is going to be experiencing some pain. And you got to fight that urge to say, hey, you know what? Let's just put everything in the Mag 7. It's working in the short term, but there will be a time and a date where that role reverses. And I fear just for clients generally, they're getting very overexposed to a very concentrated number of names, and then you start to introduce not just market risk, but idiosyncratic risks specific to those companies. It's okay to take a breath and to kind of spread the bets a little bit, give up a little bit of performance, but you will be happy on the downside. And inevitably that downside always comes.
Yeah. And it's sometimes the rest of the market is not performing well from a stock performance standpoint, but it can rotate quickly.
Correct.
And the earnings are pretty broad-based success. You look at the third quarter, I got the numbers in front of us. I guess we're a little more than 2/3 of the way through. It looks like 83% of companies are beating estimates again. And that's from earnings estimates, like 80% on revenue. And the third quarter earnings, it looks like if it were to stop right now, we're up about 10.7%.
Yep.
year over year. So this is the fourth quarter in a row of double-digit earning growth, way above the estimates we heard in the beginning part of the year.
Yeah, and the interesting thing there is that you always you always worry if you have such a high percentage of beats that maybe the bar was too low going in,
Right.
but the beats on average are greater than a standard deviation, so it's way bigger. I
Saw
mean,
that.
which kind of gives you some, not only are the beats there, but the guidance is good, and you did see as well some hints at some market breadth with like a company like Caterpillar that's doing exceptionally well, a non AI, directly AI enabled name that
Right.
is, really kind of benefiting from this new economy.
Right. So let's talk about some of the risk that are kind of maybe
Yeah.
simmering a bit. Uh, Labor market definitely softening a bit. I mentioned the layoffs. That's been a trend. Sometimes companies are opportunistic into that. They can, if everybody else is doing it, it's a way to cut costs. Also, commercial real estate, we're seeing some stress there. And there's no surprise to me, again, anecdotal, but you drive in our offices in Philadelphia. By the way, we should announce, congratulations to you. We opened up 2 new offices this
Yeah.
last month. We have beautiful office down in Center City, Philadelphia, where Dan's spending a lot of his time, and also in Radnor, PA. So
Yeah,
good
it
job.
was really exciting. And, we couldn't have done it as well without, some great new partners that have joined onto the firm. And we're just excited. It's a fun time to be growing and, working every day with our clients. So, multiple places to meet now. So please take us up on it.
Yeah, and we look forward to announcing the new teams that have joined. It's just they're in the middle of moving clients over. It
Yeah.
takes some time to kind of onboard that. But when you're in the city, especially our old building, you just a lot of people working from home. So commercial real estate is a bit of a concern. We've also had we've had some bankruptcies in the private credit area.
Yeah.
That was a kind of a hot area. A couple secondary automotive companies had gone out of business. So that's spooking the market a bit. We mentioned the market breadth is narrowing a bit, and valuations are still at a high point. I looked at something today. If you look at the equal weighted, if you can look at the S&P 500, you can buy an S&P equal weight, which it's an ETF. RSP is a symbol, and what that does is it buys an equal portion of all
Yeah.
500 S&P component companies, as opposed to the market cap weight when you buy VOO or SPY. A lot of your money is going at, you might know the percentage offhand, in technology. It's around 40%
Yeah.
is into technology. But I saw a stat this morning that the equal weight S&P is 25% lower valuation than the market cap weight.
It's really incredible. And it just goes to show you that, diversification for its myriad of benefits long term in a short term period like this, you can really underperform that way. But I still have to believe that there is value in having some additional breadth in your portfolio. And over time, these things do tend to, revert to the mean. It will not always be just these 7 companies.
Right. Yeah. So that's our message. I mean, we do remain constructively invested. We are invested, but you have to be a little bit more selective, a little bit more diversified, and a little bit more disciplined. You don't want to, put money in stuff that's already up a lot. So that's hard to do, but we're trying to do that.
Absolutely. I was just going to say, just one other thing there on the market breadth standpoint. I mean, outside of, a real AI pullback where investors kind of, flee to other areas of the market, but what other kind of, catalyst do you think will drive additional market breadth?
Yeah, I think it's common sense stuff, which will be when investors start to realize, as the valuations are inevitably increasing, that they're just not willing to pay as much for a particular stock. It's funny, being in this business for over 30 years, it's really one of the only businesses I could think of that people are happy to pay up for something. If you use the analogy in retail, it's like if that sweater you're buying, you're wearing right now, Dan, like if you were going through the mall and it was priced at $50, okay, and then you walked through and maybe went to the food court and came back and now it's at $75, you wouldn't want to buy the sweater.
Correct.
But if it were a $50 stock that went to $75, you're excited to pay
Yeah.
up for it. So people over time will maybe not pay up as much for stocks, and then you have a little bit of rotation. And you do have values. The rest of the economy is doing pretty well. So you have values in other areas like dividend stocks. We haven't talked about dividend stocks for a while, but but it's still a good year for dividend stocks. You might have, rather than a 16% rate of return for the S&P, you might have a 8 or 9% with less volatility, and that's not a bad way to go.
No, and that's what I mean. It's one strategy has definitely worked throughout the course of the year, but it doesn't mean it's the only correct strategy. So it's a good time to always focus back in on the individual client situations and really, you know, don't let yourself fall into the trap of trying to chase performance and match the S&P. That makes sense for a lot of clients. It
Right.
doesn't make sense for every client.
So we'll show our third chart. And by the way, impressive this month, only 4 charts, Dan. I like to put in like 20 charts. But again, from Fundstrat and Peter Lee, it shows this last 6 months that have been up. And the question is November, where you can see the returns for the last 6 months have been positive.
Yeah.
So he's expecting choppy couple weeks in November. Again, he looks at the technicals, then a rally into year end. So we will see. So we'll leave that part of the market conversation. We think will be okay for the next 2 months, but we will see. Let's shift gears a little bit and talk about active ETFs.
Sure.
Okay? And we'll explain what that is to clients, but it's really a space that has exploded. And active ETF assets have grown from 50 billion in 2018 to over $1 trillion today, and that number just keeps growing. And now more 25% of all ETF inflows are going into active ETFs, even though that represents only about 8% of the overall ETF market. In fact, 88% of new ETFs launched this year are active ETFs. Okay, so we'll kind of explain a little bit about what an ETF is. The first ETFs that came out many years ago were basically index ETFs, S&P 500. What are the big ones? Obviously.
Yeah, like the SPY, for example, or the VWO for emerging markets. Trying to track, either the European stocks, the U.S. equities, whether it's mid, small, or large cap. But essentially, you were paying for beta, right? You weren't trying to get alpha. You weren't trying to get additional performance above and beyond the indices. You were just trying to say, hey, what's a really cheap, cost-effective way to get access to the markets and to buy that beta?
Right. So then what happened, there was a rule change by the Securities and Exchange Commission. A lot of clients aren't aware of this. This came in 2019, end of September 2019. And basically what the commission did is they kind of modernized the regulation of exchange-traded funds to make it easier for ETF companies to issue active funds. Before, in order to get an ETF registered, basically you had to follow this basic passive market philosophy. So what you're seeing is, and it took a couple years for firms to kind of figure that out. And what we're seeing is, the new ETF, basically there's an ETF for everything, right?
Yeah.
And you're seeing new creation of mutual funds going bye-bye. You're not going to see ETFs. And we prefer them. If you look through our client portfolios, we have ETFs, and a lot of them, at least a lot of the new money is going into active ETFs. What are the benefits? One is tax efficiency. So ETFs are more tax efficient than a mutual fund. They kind of trade like a stock. You buy a share, you can sell it during the day. You don't have to wait for the closing price, NAV, at the end of the day. They have traditionally had lower fees than active mutual funds, which is a benefit. That's part of the reason why passive has outperformed. It was the internal fee structure. ETFs have lower fees. Transparency, you still now with the active ETFs, what you hold. Now, and there's a great deal of flexibility. The underlying ETFs can buy what they want and do what they want. And so and you get real active portfolio management. So some of the ETFs could take the data set of the S&P 500 companies and maybe hold 50 or 60 or 75 companies there. So it's a real trend. Advisors, especially RIAs like we are, independent advisors, are really shifting towards that area, in a big way. So we're using these tools because they also allow you to react, real time. If you want to add gold, you can add GLD, which is a gold ETF. You can do whatever you want.
Yeah, and it just it adds a tactical layer onto a portfolio, right? So if you think about owning the individual indexes, that's a strategic holding. can add some of these active ETFs that add kind of tactical overlays that allow you to be a little bit more nimble in volatile markets. In some ways, I mean, it's a little bit of a return of the fund manager, right? So it'll
Hmm.
be interesting to see, especially through the 90s and early 2000s, you had some real superstar mutual fund managers that became household names.
Right.
It'll be interesting to see if
Peter Lynch, people
yeah,
like
Peter Lynch
yeah,
and Bill Miller and
yeah,
things like
that's
that.
right.
It'll be interesting to see if that trend kind of reignites as some of these really long-term tenured exceptional portfolio managers start to kind of gain market share again, where for a while it really was the ETF was king.
Yeah, it's interesting you say that because some of them, I know T. Rowe Price, their main
Yeah.
fund, they put it in an ETF wrapper. We use Capital Group. Capital Group funds, they've taken portfolio managers in that have been in funds that have been around for 50, 60
Yep.
years. They maybe have 300 holdings in a fund. They put it in, open it up in an ETF wrapper, maybe have 100 names. So it allows that maybe a star portfolio manager to have less holdings, right?
Yeah.
So I think it's a trend that is continuing. And I think it's one of the best things I've seen in decades for smaller individual investors because again, expense ratios are lower. And just over the last couple of years, we're seeing some really strong performance of the active funds where they actually truly are beating passive. And part of that is because of the compression or reduction
Yeah.
in the fees.
One of the things we'll just have to keep an eye on over time is as the markets continue to evolve and active ETF adoption continues to increase, if they maintain that kind of competitive edge, or if they settle out in certain markets, usually smaller mid cap type names, some international. There's usually a lot of manager alpha that can be generated, but it'll be really curious to see how that trend evolves over time. But right now, you're spot on. I mean, the flows are telling kind of the full tale there.
And we haven't added, I mean, we really don't have the need to add an active mutual fund. I mean, you don't have it. So let's give our closing thoughts. And I think one of the closing thoughts, we spoke a lot about AI, but I think we're both in agreement. I don't want to speak for you on this, that it's probably not yet in a bubble, right? That's probably the biggest question we're getting from clients. Is it in a bubble? Um, but parts of it might be behaving like a bubble. So you have to be careful there. Would you agree?
Yeah, I would agree with that broadly. That I still think there's a good amount of upside in AI, and we have not quite the risk reward has not tipped into that bubble territory yet. But I'm always hesitant, and I always get accused of being very down the middle on both sides on some of these things. But an ounce of caution and just take a look at your concentrations in your portfolio. And, where things have gotten out of whack, if your portfolio on the equity side has grown too much, it doesn't hurt to take profits either. So just, be nimble out there.
Yeah, one thing we did in our 9 a.m. meeting that we have, our team meeting, we made a commitment. We're going to reach out, make sure and we'll just say it to the clients that listen to this, we're going to speak with everybody before the year end, kind of have a year end strategy meeting. A lot of clients we do speak with every month anyway. Second follow up from the meeting is, it's really good to say active management is back, right?
Yeah.
And that's important because uncertainty in the market is there, no question about it. There's a lot of risk out there. So it's good that these active ETFs can help investors navigate the market. We will take advantage of that. And the market has been strong. We think it'll continue to be strong, but it'll continue to be uneven. So we'll try to help you navigate that as well.
Absolutely.
And I would say, in our job, especially in this market, or maybe more, I'll call it like our responsibility, is to stay thoughtful, disciplined, and intentional. So we welcome any questions that you have because you could see it. That's the format. We will use it. The goal that we have, though, is not to just chase what's working last month. The goal is to try to build wealth the right way over time, not just chase the hot dot. So with that, I want to thank everybody for joining us again today for our November podcast. Dan, any closing thoughts?
No,
reactions?
I just can't thank you all enough. We're having a lot of fun doing this. I hope you guys are getting some good information and enjoying this format. Look forward to continuing to do them and keep the questions coming. It makes it really enjoyable every month to go through and see what people are asking and try and craft the message around that. So
Yeah, before we meet again in December, I want to wish everybody a fantastic Thanksgiving. I have the Philly Marathon coming up that week, so
Yeah.
hopefully I'll be probably limping around the 1st of December when we do our next podcast. But we look forward to it and look forward to conversations before year end. Thank you all.
Take care, everyone.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.